I see 5 reasons why gold goes higher. And when I say gold, I mean precious metals. The first is, as you suggest, quantitative easing. 35% of all US dollars in circulation have been created in the last 30 months. Is that to accommodate an economy that's grown by 35% in 30 months? Of course not. When that reason to own gold goes away, I'll consider selling my gold. Debt and deficits. On-balance sheet liabilities in the United States, $30 trillion or $23 trillion net. Off-balance sheet liabilities, net present value of off-balance sheet liabilities, $125 trillion. Congressional Budget Office number, not some cranky, bald libertarian. So the total debt, not including federal, state, and local debt, not including unfunded pension plans, is just shy of $150 trillion. We service that with a budget that's in deficit by $2 trillion a year. In other words, rather than service it, we add to it by $2 trillion a year. When we balance the budget, and when we begin to make a meaningful contribution in paying down the federal debt, I'll sell my gold. The real killer for me is negative real interest rates. If you look at the competition for gold, I would suggest that the most formidable competition for gold has been the U.S. 10-year Treasury, which has outperformed gold substantially for 40 years. But now the U.S. 10-year Treasury pays you 200 basis point nominal yield in a currency where the purchasing power is declining by 850 basis points nominal yield. The U.S. government absolutely, positively promises to reduce your wealth by 6.5% compounded every year for 10 years. Mm-hmm. Jim Grant calls that return-free risk. When we have a positive real interest rate, which is to say, when the U.S. Treasury pays me 150 or 200 basis points real yield above the CPI stated rate of inflation, I'll sell my gold. Mm-hmm. The consequence of those 3 factors, the manifestation of it is in 2 places. One, the market share of gold relative to other asset classes after 40 benign years is minuscule. 0.5% of total savings and investment assets in the United States is in precious metals and precious metals related equity. That's down from a 4-decade mean of between 1.5% and 2%. If you are a manager, let's just say for fun, you were a manager of the CPP, and you are responsible for the well-being of Canadian pensioners 20 years from now, 30 years from now, 40 years from now. And for the last 40 years, 60% of your portfolio has been in equity or alts, and 40% of your portfolio has been in bonds. For 40 years, it's been a great place to be because declining interest rates has meant that the capitalized value of the distributions of the bonds you bought have done very well. So you've had security of income at the same time that you've had capital gains. In a period of rising interest rates, that's over. 40% of your portfolio is now invested in instruments that guarantee that you are not able to look after your pensioners 20 years from now, 30 years from now, 40 years ago. Mm-hmm. You have to do something about that in the next 5 years. You absolutely, positively have to do something about that unless you believe inflation is transitory, which I don't believe anybody believes. I believe that quantitative easing, debt and deficits, and negative real interest rates between them will cause the market share of precious metals and precious metals related securities to at least recover to their 4-decade mean. If that happens, demand for precious metals and precious metals related investments will somewhere between triple and quadruple when the market share of precious metals in the US economy goes above 2. When you have positive real interest rates, when we balance the budget and begin to pay down the debt, and when governments start counterfeiting, I'll sell my gold. I don't anticipate that happening anytime soon. I can't imagine what it would be like to be a portfolio manager of a university endowment or a pension fund or a life insurance company right now, understanding that everything that you've done for the last 40 years guarantees the ultimate bankruptcy of your fund. Think about how you need to reorganize what you do, particularly in a market like today, which is plagued by both volatility and illiquidity. I'm delighted that I don't have that job. People's anticipation of the future is set by their experience in the immediate past. We've been through now 4 decades where inflation hasn't been a consideration and life has just gotten better. My first bull market was the bull market of the 1970s. The writing was on the wall for inflation beginning in 1967. 1968, 1969, 1970, 1971 featured high inflation, but nobody cared because their experience with the past 20 years had been fairly benign. It wasn't until inflation worked havoc with their paychecks, with their savings, with their lifestyle for 4 years. It wasn't until inflation bit that it went from being an item of interest to an item of fear. We've been through a circumstance now where inflation has been a consideration for about 12 months, but it hasn't bit people. If somebody gets a 3.5% pay increase in a currency that's depreciating by 8.5% a year, it doesn't impact their lifestyle right away. If somebody has $100,000 in the bank, which is to say they have some liquidity, the fact that the purchasing power has declined doesn't hit them right away. When the price of shelter continues to go up and it becomes unaffordable, really, truly unaffordable to Americans and Canadians, to the point in time where a shopping cart full of groceries is a consideration rather than an annoyance, then I think that the appeal of precious metals and precious metals related assets will become immediately apparent. But I really have noticed that when I go into investment forums around the world and talk about contrarian investments, when I talk about things that have to go up as opposed to things that have gone up, people don't care. People require the validation of the thesis by price action, which is to say somebody doesn't want to buy an asset class until it's already fully or overpriced because they need the psychological justification to give verification to the narrative. Most 10-baggers in my career, almost all of them, in fact, all of them that I enjoyed in size, have taken between 5 and 6 years. And in every circumstance that I can remember, at least at one point in time over that 5 to 6 years, the price of the security has fallen by half. So you have to be, first of all, fairly durable. You have to be able to endure the psychological difficulty of seeing a $4 stock become a $2 stock. At the same time, you need to understand that although you might want this wonderful event to happen in calendar 22, neither the stock nor the market cares too much about what you want. You have to assign yourself a narrative that's achievable.